My name is Annette Petersen. I am with Credit Union West. I am the real estate lending manager. But there have been some changes to HARP, so those of you that were familiar with it from before, there's a couple different versions of it. In fact, there was an update as late as yesterday on the HARP. But basically what HARP is, it's a government-backed program, and it affords homeowners where they lost some of their value, and they may be upside down in value, and upside down means you owe more than the home is worth, or you owe more than 80% of what the home is worth. So you don't have to be over 100%. HARP is now defined as over 80%. So if you owed 85%, your home's worth $100,000 and you owe $85,000. If you meet the other criteria that we'll go through tonight, you could be eligible for HARP, okay? And we'll go over what all of the different requirements are, and they really are not that many. So that's the good news. But originally in late in 2009, HARP came out, and what they originally said is if you were up to 105% loan to value on your home, that you could refinance through HARP. Well, here in Arizona, 105% didn't touch anybody that was upside down. So the majority of the people here were well over 125% if they had taken out a loan or bought the home somewhere in the 10 years prior to that period. And when our values peaked in early 2007, and the 2 years that followed that, they came crashing down quicker than they went up. And a lot of homes that really weren't even caught up people had purchased prior to 2002, they still lost value, even based on a very low value that they purchased. So we went way high, but we came down even farther. So the government said, hey, we need to help these people that aren't giving back their homes on a foreclosure. They're not asking for a short sale. They're making their payments. They want to stay in the home. And we need to find a way to help these people too, because this will help us cure part of the problem is by keeping people in the homes. And we talked to a lot of people that said, look, I don't want to walk away, but I can't refinance, I can't get lower payments, I can't do anything, and I'm going to be spending all of my retirement money trying to recoup this upside down $50,000, $60,000, $70,000, $100,000 in some cases. So finally, after 2.5 years of the housing market crashing, the government said, okay, here's what we're going to do. We'll allow you, if you're upside down, up to 105% to go ahead and refinance. And I think that fit 2 people in the state of Arizona. So in 2011, they came out with HARP 2.0. And it doesn't even have anything to do with Microsoft, but they called it 2.0. So with the 2.0, they said, okay, we will allow you to refinance if your loan is now owned by Fannie or Freddie Mac, and both of those are now pretty much owned by the government. We'll allow you to refinance, not take any cash out or not do anything, just take that payment and lower it. And that's when the program really kicked off here in Arizona. They have helped a lot of people through this program. When you figure the historical rates between 2004 and 2007, even into 2008, were anywhere from 6.5% to 7%. And when 2011 came along and everything was at rock bottom, and you were getting 1/8 on your savings, but you were also only paying about 3.5% on your mortgage if you took a new one out. So there were huge savings. And the government felt if you could save $400 or $500 a month on your mortgage payment, that might also help the economy by putting more money back out there. So 2.0 came out, and when it first came out, they said it's going to expire in 2013. So you had a very short period to go ahead and get this done. Now, at the beginning of this year, they extended it out to 2015. So if you see here, in December 31, 2015 is when this program is set to expire. And they're hopeful that anybody that can be helped and wants to be helped through this program and stay in their home we'll have done something about it by then. So really from here, it gives us at least another 2 years to help those people that might still be upside down that have not already done something. And this shows you a graph, and it's good, most recent data we could get through February of 2013. And this is the amount of borrowers that are taking advantage. If you look over here, the numbers of people taking advantage of the program. And it goes by February of 2012 to February of 2013. What it also shows you is the first bucket with the blue is loan to values where people were 80 to 105, because when HARP first came out, you could only go 105. If you were over that, which didn't make sense, but I said, no, we can't help you. So you're going to see a lot of the blue early on. And then in the red, you've got loan to values from 105 to 125. Because some lenders, even though HARP said we'll go unlimited loan to value, some lenders said, I don't really want that exposure, so I'm going to cap it at 125. So that's why you have the ones in the red. And then after they open it up, there are quite a few lenders that stepped up and said, okay, we'll go above 125% and still refinance your loan. Because there is still some sort of risk to a lender doing this. So that's why the lenders get to pick and choose whether they want to participate in this program or not. So it really makes sense for you to shop. If one lender tells you no, that doesn't mean you can't do it. It just means you probably need to check a couple other lenders out, okay? And I recommend that no matter what you do. So that's where that's at as of February, and I'm sure it's changed. The majority of them probably are switching now. If we looked from February until September, you're probably going to have a lot more in the green, because the people that could take advantage at the 105 have already done so. All right, so then we get into who is eligible for this program. If you're current on your mortgage payments and your home value has decreased to where now your loan is greater than 80% of the value of the home. This was a little bit more important about 1.5 years ago before we bottomed out, because as we were still going down, most people were well over 80%. But things are starting to come back around. You should see it in your neighborhoods. You should see homes selling more quickly. You should see values starting to come up. Hopefully they don't skyrocket back up, because that would be a false thing, and we might not have learned our lesson, and we might be back in this situation. So a little bit of growth is good, and that's what we're seeing. We are seeing people back interested, and the good thing is we're seeing people that want to be homeowners versus investors coming in and buying 4 or 5 homes on your block because they want to make money on them. So if you're current on your mortgage payments, and we'll get into what current means as far as the program is, because it doesn't necessarily mean what it looks like it might mean. And you're over 80% loan to value, and we're talking only your first mortgage. This whole entire program is strictly about your first mortgage. If you had a second mortgage, if at some period your house value went up and you decided to take a second mortgage, this has nothing to do with that. If your loan is owned or guaranteed by Fannie Mae or Freddie Mac, and there was a period of time, several years, where you couldn't figure out who owned your loan, now they've come out with some ways, and we'll get into those, to make it very easy for you to determine who now holds your loan. And when we say hold your loan, they basically hold that deed of trust, which is a security interest for you to repay that loan. They don't service the loan. You don't make your payments to them. You may make your payments, you may have in the last 5 years made it to 4 different people if they keep selling your loan, but that's not who owns it. So it's really important to know it's not the person you're paying. If you have to look at these 2 programs and see if they own your loan. And this is new, and we didn't even have time to change it, but when HARP 2.0 came out, it said if your loan was acquired by Fannie or Freddie prior to May 31st, 2009, prior to, then you would be, that's the main eligibility, that you had to have had it prior to that. Because what they felt when they built this criteria is if you took your loan out after May of 2009, you were fully aware that values were still going down, unemployment was up, things were still happening, we were not stable, and that you were fully aware that there might be some issues going forward, and there was enough information out there at that point to help you make a valid and correct decision. So they picked that date. And at one point prior to yesterday, you may have taken your loan out in 2006, but your lender, whoever it was, may not have sold it to Fannie or Freddie until 2010. So you would say, well, I think I'm eligible because I did take my loan out prior to May 31st. It didn't have anything to do with when you took it out. It's when Fannie or Freddie bought it. And there were a lot of lenders that, as things were going down, they bulked up pools of loans and sold them to Fannie and Freddie. And they did that for a couple reasons: to reduce their portfolios, and also Fannie and Freddie wanted to buy those loans so that they could offset the bad ones. So now, as of yesterday, I think they felt that there were too many people saying, I'm not eligible, or my loan was taken out prior to this date, but they're saying I can't. So they want to help more people, and they're hoping to get it all stabilized. So they said it doesn't matter when they purchased the loan. If your note date is prior to this date, you'll be eligible. So that's good. That takes out some of the confusion, and it should help another percentage of people. So this is, again, Fannie and Freddie are pretty much owned by the government. So this is direct from their website, and they say that homeowners with HARP 1, that homeowners who had already taken advantage of the Home Affordable Refinance program were 1.5 million. And then they came out with the HARP 2.0 because they felt that there was still another 16, if you add the two together, the 4 million that after HARP 1, that would still qualify. So as of the date this was done, which was earlier this year, there were still 12 million people that they have identified that should be able to be helped through this program that have not yet done so. And I think the majority that have not been able to is because there is the confusion, and that's why lenders are going out and talking about this HARP, because the opportunity is now. The rates are still pretty good, and if there's 12 million people that we can, as lenders, help reduce their payments and save more money, it's going to do nothing but help the rest of us as well. So a lot of them have gone to their lender and said, can you refinance me under HARP? And they said, no, we don't do HARP. So they felt they could not shop somewhere else. That if their lender who owned it now didn't do it, they couldn't do it. And that wasn't true. So we're hopeful that in the next 2 years that a large percentage of the 12 million that are still sitting there will be helped. So what's the benefit to doing a HARP refinance? Obvious reduction in your interest rate. And like we said, probably the bulk of the ones that in the last 2 years that I've seen, 3 years, 7 to 6.5% on a 30-year fixed rate. And right now, as of today, a 30-year fixed, and this can vary by lender, and I'm only quoting the rate I know, but is for a HARP refinance on a 30-year fixed, and again, unlimited LTV, is about 4.5. So if you can save 2% on your interest rate, and what they do is they go and they re-amortize it back over a 30-year period again. So redoing that is still going to save even more. The reduction in your monthly principal and interest. And that's the P&I portion of your payment, principal and interest. And replacement of, if some people still had the adjustable rate mortgages and they couldn't get out of them because they were upside down. Or they had the negative interest loans where they gave them interest only, and then they gave them a teaser start rate. So maybe they were paying $600 a month, on a $300,000 loan, and maybe they had $2,000 a month going negative back onto the principal balance of the loan, and they couldn't get out of it. And I would venture to say that the majority of the people that first walked away when they couldn't get the help were those people. Because with a negative interest loan, when your balance got more than 20% of your original balance in negative interest being capped on top of it, they re-amortized your loan. So your payments could have gone from $600 up to $3,000 overnight. That was a hardship. And then some people are even saying, you know what, if I could actually refinance this, I can afford the payment I have, but I'd like to have a lower payment. And so they're also taking the opportunity to lower the term. We've seen people go that have had their loan for 5 years, and now they're going to take it out on a 15-year. They're going to save 10 years on the term of the loan, and they're going to put themselves in a position so that if something like this happens again, they're not a victim to it. So you're basically just paying off your principal that much quicker. And the 15-year rates, and some have even taken out 10, are typically, for this type of program, anywhere from 1/2 to 3/4 of a point lower in interest rate than a 30-year would be. So you save even more. Then the benefits. So it's a more affordable payment. You build equity faster and you save money. So we actually have people that are making the same payment they were making before. So the extra $300 or $400 that they're saving is now going straight to the principal of the loan every month. And they just want to be done with a mortgage. So it's a great benefit. It makes your loan more stable. You don't have the adjustable rate, don't have to worry about it. You can stay in your home and avoid foreclosure. If you have a cheaper payment and you had a financial hardship along with the upside down on the home, hopefully there's a lot of people that have been the benefit of keeping that home. And I can tell you we've met a lot. There's no minimum value required. That's never been done before. So it doesn't matter what your loan is. It doesn't matter what your loan to value is. If you fit these guidelines, you can refinance. No maximum combined loan to value. This is kind of a little bit of the second, but if you had your first mortgage and then you took out a second mortgage, if you were coming in for a loan that was not home affordable refinance program, okay, not part of this, but you just came in and said, I want to refinance my home, and it's worth $100. I owe $80,000 on the first, and I owe $20,000 on the second. So now you're 100% loan to value, but $20,000 is on a second mortgage. The lender will tell you, I'm sorry, we can't do that. Because the guidelines say you can't be greater than, at least most of them say, and I can't speak for everyone, but most of them say 95%. So you would not be able to refinance. This one takes that limitation away, so it doesn't matter. They're going to refinance the first mortgage and leave that second mortgage in place. There are some state programs, though, that might do something different with that. And at the very end, we'll give you some information on that. And mortgage insurance is, if you're not familiar with what mortgage insurance is, if you bought your home, let's say through FHA, which allows for 97 at that time, 97% loan to value, so you only put 3% down, or a 90% Fannie Mae loan, so you only put 10% down. Lenders say if you don't put 20% down, then you have to have private mortgage insurance. And these private mortgage insurance companies, what they did is they insured the lender for the difference between the 80% and if you were at 90, that 10%. So if we had to take a loss on that home, they would give us 10% of the original balance. You paid the insurance, but you weren't insured, the lender was. But it's because they were taking a greater risk. You did not have 20% into the home. You couldn't afford that, but you still wanted to buy a home. They said, okay. So you paid a monthly payment for that mortgage insurance. Now with HARP, if you bought that same home, $100,000, and you put $20,000 down, you were only at 80% You didn't have to have mortgage insurance. But now all of a sudden with your values upside down, now you owe $100,000 and you go refinance with HARP. They said if you did not originally have mortgage insurance on your loan when you started, irregardless of where you sit today, you're not going to have to pay it, which is a big relief. That helped a lot of people. A lot of people thought, okay, well, I'm going to go in there and they're going to make me pay. And some of those mortgage insurance premiums were pretty hefty. So, and your credit can be, doesn't have to be perfect. There can be some glitches in it, and you can still qualify for this program. Remember, it's the same owner of your deed. They already know how you make your payments to them. And that's the best record they can have. So some of the other credit qualifications that may be there if you went to go get a new loan outside of HARP may be lifted, which is also proven to help quite a bit of people, because along with the housing crunch, we also had a lot of people on unemployment that could not afford to make all of their payments and had some issues with the credit. So this is a big benefit. So how do you know if your loan is owned by Fannie or Freddie? There's two different websites that you can go to. This is the Fannie Mae Loan Lookup tool, but it's very simple. You go in and you put in your first and last name, the property address, the city, state, and 5-digit zip code, and the last 4 digits of your Social Security number. So if you went in there and put all that in, and then you have to mark the little box in the corner here that says, I confirm I'm the homeowner. And in most cases you have to be, because it's the last 4 digits of your Social Security number you have to put in there. And you hit Get Results. And then it's going to tell you whether it believes it owns that loan or not. And if it doesn't, it's also going to then give you a link to Freddie Mac's website. And vice versa. If you went to Freddie Mac first and it didn't find your property, it would give you a link to Fannie Mae. But I want to make something very important here, is that you get the address right. And what they are doing here is there's a huge database that's got every property address that they own. And they got those property addresses by your deed of trust when you took the loan out. So if your lender mistyped your address, or they did street versus avenue, then you may not find a match and they may still own it. So if you firmly believe that your loan is owned by Fannie or Freddie and you cannot find it in these sites, it's telling you no, there is some other research tools through Maricopa County Recorder that you can do to see how that deed was recorded. And then this is what Freddie Mac's tool looks like. It's got the same information. They're looking for your first and last name, your house number. This breaks it out. They want your house number, then they want your street name only, and then they want whether it's the suffix there, whether it's a lane or a drive, and if you do have a unit number, you would put it in. City, state, zip, the last 4 digits of your social, and the tiny little box down here that says you're the homeowner. You have a couple different options when you go to look to do a HARP loan. You can go back to the person who's taking your payments and say, do you do HARP? And they can, if they say yes, you can do it through them. But they also open it up to where you can shop, which was very smart of them to do. Because what happened when it first came out, the lenders, you had some very large servicers that had the bulk of the loans. And either they were very slow doing them, they wouldn't respond, and people just felt they were getting nowhere. So they came out and said, okay, you can go now to any lender who's willing to do this home affordable refinance program. And those would be lenders that sell direct to either Fannie Mae or Freddie Mac. So if they tell you no, it's because they don't sell direct, or they just are not doing the program anymore, okay? But there's different qualifications. If if I already own the loan and I'm servicing it, then the risk is already sits with me. And I'm going to have different requirements for you to qualify for HARP than if I'm a new lender taking on a home that's upside down. So in most cases, if you can get your lender to do so, it's probably going to be in your best interest. But if you can't, and it still never hurts to shop around, I would, even if they say, yes, we can do it, we still always recommend you go get another quote or two somewhere else. Because irregardless of where you go, the qualifications are very simple these days for this HARP program. So, and there are a lot of servicers where you're making your payments to that they do not originate loans. So they cannot, even if they wanted to, they cannot do the program for you. Okay. So again, we recommend that you contact first go to the site and find out who for sure owns your loan. Because when you call your lender and you get quotes, it's going to be very important for you to know who owns your loan. Because some lenders will do Fannie Mae and some will do Freddie Mac, but very few will do both of them. And the reason they don't is the qualifying and the record keeping and the audit process to have two major lenders to sell or agents to sell to is just too difficult. So they'll normally do one or the other. So contact a few, ask if they're approved HARP lender. And the government has the HARP website that you can get more information, and they should have links on there about who is approved to do the HARP loans. Make sure you have your basic financial and loan information on hand when you call. And then check with the Arizona Department of Housing for information on funds availability and qualification of funds for the hardest hit states program. This one's really important. And we do have some stuff, and I would highly recommend you write down this website. What this is the government came out probably 2.5 years ago with funds that they gave to the states, and they allocated it by what they considered the hardest hit states were. Well, obviously Arizona was one. We were very hard hit. So what they gave the state of Arizona monies, and they said, we want you to go out and help these people that are upside down in their homes and are having financial hardships, and this is money to help them stay in their home. So here's, if you were to apply for HARP and you've now found your lender, this is what they're going to need from you. So when you're going to get your loan information and everything else, we highly recommend you gather this same data. It doesn't change by lender. Okay, this is the requirements for HARP. So you want your current mortgage statement, and if you've received any notices or letters, like maybe it's been going to be transferred or has been transferred, or if you've applied for a hardship and they've declined you, you want to bring all that stuff with you. Your current statement for any other loans or lines of credit that you have on that home, because it's going to be important that they determine what the combined loan to value is and what your debt to income ratio is. Then your income information, and there's various income information that could be needed depending on what your income situation is. If you are a wage earner and you work for someone else and they give you pay stubs, you're going to need your most recent 2 pay stubs and your most recent 2 years W-2s from that employer. And then alimony and child support, if you want to claim that. You're not required to, but if you wanted to claim that for income, then if it's being direct deposited, you would bring that in, and you would bring in a court order showing how long it's likely to continue. And then irregardless if you have direct deposits for your income going into your bank account, we need 2 months most recent bank statements, and that's all pages. And that's for any assets you are going to list on your mortgage application. And then the only time you need the last 2 years' tax returns is if you're self-employed or you have rental properties. So you have some other form of income that doesn't show up on your W-2s or 1099s or bank statements. Typical cost of the program can vary by lender. And to start out, most lenders will put these costs back into the loan. So it's really not coming out of your pocket. And with the HARP 2.0, a large percentage of the homes do not need an appraisal. We, lenders use a valuation model, and every one of them varies. And you mentioned Zillow. Most lenders don't use that. They do have programs that they buy into, but basically all it is recorded data of sales of homes that are similar to yours, square footage, that's all being thrown into this module. They're all artificial intelligence. They really can't tell what your home looks like versus this home over here, but it really gives us some good idea of what's going on in your market area, and then adjustments made to conditions of home. But that's the biggest, one of the biggest costs in refinancing right now is $450 for an appraisal. And that is, appraisals now have to be ordered by third parties. So lenders can't order them direct because they don't want the lender influencing value of homes. So calling the appraiser and saying, I need this to come in at $250,000. And I've got 10 more orders to give you. Well, that's going to come in at $250 somehow. So now the lenders are not allowed to talk direct to the appraiser. So it gets ordered through a third party. Did it add a little more cost? Yes. But you should be getting a very accurate, true value of the home. So much more worth it. Title report fees, credit report fees, flood cert tells if your property is in a flood zone, and we kind of laugh and say, well, we're in Phoenix, we're not. But it's a lending rule on mortgages that you have to have a flood cert. A tax service fee, what that does is it goes in and makes sure that the property taxes are paid. Property taxes not paid can go in front of a mortgage lien, and they can take the house back or resell it. So it's very important on that. Recording fee, what that does is it releases the other lien that is being paid off, the other mortgage, and records the new deed on your title. Then an escrow fee, what the escrow fee, an escrow company is a non-interested third party. So what they're going to do is they're going to collect our information. They're going to collect your current lender's information, and they're going to make sure your old loan gets paid off, the new one gets done right, and they're going to disperse monies and send them where they need to do. And they're charged with doing that right. They are a non-interested third party. So you've got the escrow fee, and the impound reserves for property taxes and insurance. So every single one of these HARP loans, you must have your property taxes and insurance impounded in the loan. And by impounded in the loan, your payment looks like it's higher, but they're basically collecting a monthly portion of your property taxes and your insurance, and they will make sure those get paid. Then the appraisal fee, if required. And the only way to know if it's required is when your lender works with you and you bring all this in, they're going to input it into something called an automated underwriting engine, which belongs to Fannie and Freddie. And it's going to come out and say, okay, yes, it's eligible for HARP, and here's what we need. And if the value input by that lender is acceptable based on their knowledge that they have on the background, they will say, okay, no appraisal required. But it's strictly up to that approval. And then any points. So what are points? Points are a percentage of the loan. So if somebody says, I'm going to charge you 1 point, and you took out a loan for $100,000, that's $1,000 is a point. So if you've gone to, a lot of lenders on these do not charge the points. Some might, because maybe they're just a pass-through back to Fannie or Freddie. And they have to do something. They're not a nonprofit. So that may be where they get their funds. And then any prepaid interest. So prepaid interest. If you close on the 15th of November, your first payment is going to be January 1st. And when you make January 1st payment, it's going to be the interest you're paying on January 1st is December's interest. So they can't charge it to you before it accrues, so you're paying it in arrears when you make your payment, but you now closed November 15th. What are we going to do with those 15 days between when you close and when your interest starts accruing on the loan for December 1st? That's the only interest you pay up front. So it's really crucial. Some people say, well, then I'm not closing until the very last day of the month. If I do that, I really don't have any prepaid interest. So it's according to what you want. Some people like to say, I want to close at the beginning of November, knowing I can almost skip 2 payments. What could I do with those 2 payments? Could I pay down some other debt? It's really up to each individual person what they want. So here are some resources that you could go to. And we highly recommend that if you are really wanting to look into everything that's available to you, that the HARP 2.0 will provide for you, or even just find more information, then you visit some of these sites. You've got Fannie Mae. Making Home Affordable is the government website, and it kind of umbrellas both Fannie Mae and Freddie Mac. And that's going to be the most recent place you can go for information. If they were to come out with a HARP 3.0, this is probably where you would see the information first. And then the one last thing I want to say, anytime a program that's good comes out, that's there to help the people, there's somebody else there that wants to take advantage of it and make you think that they're there to help you. So be aware of who you're dealing with. If you have not, if they call you on the phone and you haven't heard of them, don't give them any information over the phone. Check them out, find a website, do whatever, but always know who you're talking to. Okay, and so if you make sure that you're the one reaching out for information for the Home Affordable Refinance instead of someone calling you, then you're probably going to very much protect yourself. But here's places where you can go. Check with your mortgage company. HUD, which is Department of Housing and Urban Development, they have different information links on there to help you to find a housing counselor. Don't let somebody call you out of the blue, okay? You want to be the one reaching out for the information. And then if you think you have somebody that is trying to do something that's not less than stellar for you, you should probably turn them into the FTC. And their website also has all the latest scams that are going on as well. Well, thank you very much for coming. We hope that this is some help to you, and hopefully we can all get back on track with the values.